Good morning, everyone. Thank you for being here. Happy April 25th, 10 a.m. Welcome to our Q1 economic update. I'm glad that everyone could be in attendance. I'm Marshall Gunn. You probably know me, so that's great. It's hard to think that we had our annual economic update 3 months ago. If you recall, the U.S. economy was beginning to slow. Inflation was declining. The Feds were pausing. We had unemployment continuing to hover at all-time lows. We were optimistic that the federal rate adjustments would result in that soft landing that Chair Powell keeps telling us about. We're anticipating federal rate cuts would be starting right about now, and we were all adjusting to the new norm. Americans continued to spend on fun and family with their friends and their family traveling and entertaining, even though they're having to spend a lot more than they did last year. So what's all this mean? Well, joining us today is Pat Gauthier from the Chief Investment Officer with CPS Investment Advisors. Pat, help us out and take us through what's going on, at least with the market side of the world.
Absolutely. Thank you, Marshall, and happy to be here with you again today. And really what we're looking at here is just a start to another year in the markets. So let's dive in and take a look at where we've been so far here in 2024. Kind of a rough start there in January. There were some mixed expectations in the market. Started down a little bit here to begin the year. Towards the end of January, pretty robust spike there for the major indices, and then probably what you consider your typical bumpy ride through the end of the quarter. I think a lot of us would be pretty happy with those returns for a full quarter if we were able to just fast forward to the end of the year and lock these in. So you've got your S&P 500 total return level at about 10.5%, NASDAQ just under that at about 9 1/3. Dow Jones still pretty respectable, 6% in a quarter. And then you've got your Bloomberg US aggregate. That's your bond index, and that's down just a little bit for the year. And that's mostly due to a change in rate expectations, which we're going to cover here shortly. But I think if you zoomed out, this would look a lot smoother. But again, for the full year, I think we could lock these in and I'll be pretty happy with that. Nothing out of bounds, as we'll show here in a moment, but we are looking at a pretty typical year in the market. A lot of things coming up here for 2024 that will continue this volatility. What's driving the market here for the last 6 months or so really is the Mag 7. If I had a nickel for every time I heard Mag 7 in the news, I'd be down on the Virgin Islands with Marshall at some point. But the names: Microsoft, Apple, Nvidia, Alphabet. 6 companies are worth more than $1 trillion at the end of the quarter. That's changed a little bit in roughly a month or so, but take a step back and think about that from a global perspective. 6 companies worth over $1 trillion and a couple worth $2.5 or $3 trillion. If you look at the global economy, all 6 of those companies would be in the top 20 of global economies on their own. So pretty impressive, pretty unprecedented as well, if you will. And when's the last time you had 6 or 7 companies worth more than most other countries in the world combined? One note I want to make on these: if you take a look at where these companies are, most are domiciled here in the U.S., and we'll hit that theme later on, that this is where the innovation happens, and we're fortunate to be a part of that market. But kind of a unique situation where you take a look at some very focused companies in terms of technology, how they're priced, and how the market is expecting them to perform over the long term. Tesla is also a unique looking company. Depending on who you talk to and which conversation you have, you're looking at, are you pricing a technology company? Think robots, automated driving, battery storage for renewable power. If you're talking that side of the market, Tesla has a ton of value. You can see exorbitant prices in Tesla. If you talk the other side of the market, the nuts and bolts of a car manufacturer, we have to make high quality vehicles that people are willing to pay a premium for, and we have to make them safe and efficient and deliver them on time. Could be a much different pricing story. I think we're starting to see that side of the Tesla story play out a little bit as you've seen the valuation come down, particularly here after earnings. But not uncommon when you see concentrated rises like this. Tesla is that perfect example of a lot of hype and then a little bit of reality setting in. If we fast forward to this chart into April, you're going to see that, a number of these Mag 7 companies, if you will, are starting to see reality set in a bit. You have your NVIDIA thinking, hey, how long can people continue to pay for these high priced chips, and how many more of them are they going to need in the short run? You have Apple looking at slowing iPhone sales and being a little bit behind on the AI side of things. And then if you saw the market this morning, Meta or Facebook reported some pretty strong earnings, but their simple outlook has got them down double digits this morning. So certainly a unique market. You're finding a lot of folks taking a look at those trillion-dollar valuations and starting to take a harder look at what's under the hood there. So when we get into that bubble situation, and I hesitate to use the term bubble because it's far different from the early 2000s, but when we get in that situation where valuations are skyrocketing for a very small number of companies, it brings to mind this chart. And I'm sure a lot of you have seen this chart from CPS over the years, and I know Marshall has used it in the past. But there's a few common themes here that I think are important. Number one is that you see the red dots in every year going back to 1980. There's a red dot. What does a red dot indicate? It's the intra-year market decline. It means at some point during that calendar year, the market was down by that percentage within that 12-month period. The other side of that is the blue bars, which is the actual annual return. And you'll see that for the most part, they're positive. 33 out of 44 years is positive. So had you stuck with it for the full year, you would have ended up in positive territory. The third thing that I really look at is if you go back to the 80s and into the 90s, you'll see that those negative numbers are single digits for the most part. You've got a handful of teams in there, but those are single digits. And then you see some still pretty robust returns there. You start moving into the 2000s, and then as of late, you start to see some double-digit declines. And really, that's just an indicator of the way the market has changed over the years. Technology has brought on some advanced trading capabilities. Markets move a lot faster. Information moves a lot faster. So volatility is picked up historically from where it used to be when things were over the phone or on paper tickets. So not necessarily any more risk in the market, if you will. It's just the nature of the way information moves is going to be faster, and you're going to see some more volatile swings in the short term. All the more reason to stay invested for the long term and to let the market do what it does without worrying about much of the day-to-day ups and downs. Still talking rates. Yes, unfortunately, rates are still driving the market. We are still talking about interest rates. If you've been attending here for the last year or so, you have heard me talk about rates. So we will continue to do so in the near term. What we're looking at here is what's called an inverted yield curve. That means the short end, the 6-month and the year, are charging higher interest rate than the long-term treasury bonds. So the short end, as we know, is driven by the Federal Reserve. They set their Fed funds rate, and that generally dictates interest rates on the short end. The long run is more driven by the market and economic conditions and expectations. So we are currently in one of the longest, or if not the longest, inverted yield curve that we've seen. Now, it's always been used as a recession indicator. Once the yield curve inverts, recession is coming at some point, and it's been a fairly reliable indicator, particularly the longer this inversion lasts. So that has a lot of folks spooked in terms of when is that other shoe going to fall for the economy? When is the Fed going to change interest rates? So I back up to the high level view and say, what were the expectations to start, and what would cause the Fed to change rates? So we entered this year with expectations of rate cuts. We all had consensus estimates out there that the Fed would cut rates 3 or 4 times by the end of the year. That outlook is changing. You're starting to see the market reprice on the long end of the curve. So how does it work to get the yield curve normalized? When those expectations change, the long end can come up. So your 10 or 30-year bonds can start, looking at 5.5%, 6% interest potentially. You could also have the short end come down, where the Fed starts to cut rates quickly and you start to get 3 or 4% on the short end. Most likely it's going to be a mix of the two. It's going to be the market readjusting their expectations on the long end, and the Fed understanding what's going on in the economy and starting to bring the short end back into a reasonable range. So continue to keep your eye on this. We'll talk a little bit more about rates here shortly, but Unfortunately, we're still in the situation where the Fed is the dominant player, and their decisions are going to have a very outsized impact on rates here in the near term. What are some of those things that are going to cause the Fed to cut? The first is going to be inflation. We know the story of inflation over the last few years. We're down in the 3% range, depending on how you cut it. Overall, I think we've done a pretty good job of having inflation go from 9% down to 3% without breaking much in the system. If you rewind to mid-2022 and we print 9% inflation, and then old economist Pat walks in and says, we're going to get back to 3% inflation and we're going to keep unemployment under 4%, I don't think many people would have made that bet. So it's a little bit of a surprise for the economists out there that we've gotten to where we are without having more dramatic effects in the economy. Because typically one of the main ways you break inflation is you have people stop spending money. Our friends, the consumer, need to stop going out there and buying the things they want to buy. And to a large extent, that has not happened yet. So inflation is obviously key. We want to keep an eye on those numbers. The target is 2% for the Fed. How quickly we get back there is going to be a big factor in what the Fed does with short-term interest rates here. The other factor is jobs, and this plays into inflation to a degree. We've got still 8.7 million open jobs here in America. Pretty good problem to have if you're out there looking for work. The unemployment rate's still hanging out under 4%, which is a positive. Again, going back to where we were just 2 years ago, I don't think a lot of people would have called that we'd be in this situation with folks still employed, wages still growing on a real basis, and folks still being able to go out there and change jobs as they need to. On the employer side, if you're out there trying to hire folks, it's easing a little bit. You're able to find some people that are willing to work for reasonable rates, but the longer inflation sticks around, the higher those wage growth rates have to be for people to be able to continue spending money in the market over the long term. So that's my second indicator, is the job market. If something breaks in the job market, expect to see the Fed make some changes relatively quickly. Looking at the effective federal funds rate, you'll notice this chart is backed out into the 1960s. And hey, Pat, why do we care about federal funds in the 1960s, right? A lot has changed since then. But it's important to take a long-term look at where we are today versus where we've been historically. There's a lot of talk out there that something's going to break in the economy and the economy can't withstand these rates, they have to come down. Not necessarily. In a lot of our lifetimes, we've seen rates much higher and the economy is done just fine. It may not grow as robustly. It may not be as dynamic as when money is essentially free and you can fund any business you want. But we figure it out. Folks are still going to go out there and buy their groceries, and they're going to spend their money when they have extra money. So it's an interesting look at where rates are today versus where we've been. And I also like to use this chart to illustrate that a Fed rate cut, or a rate cut path, if you will, doesn't necessarily mean we're going back to zero. You do have to remember that this is one of the main tools for the Fed to maneuver in the markets, if you will. So in a true crisis, cutting or raising the Fed funds rate is one of the main tools. If you cut it all the way back to zero right now, outside of a crisis, you've shot your bullet. You have one less tool to use if you really need to stimulate the economy in the future. So look at that long-term average as more of a bellwether, if you were, for where rates should normalize moving forward. So if I had to give a prediction, I would anticipate we're going to oscillate around this 4.5–5% range for a while, barring an economic catastrophe. The Fed wants to make sure they have, those cards in their hand that they can play in the event something strange actually happens in the market. That recency bias that a lot of us fall victim to, and I'm sure you've heard it in conversation. We're crushing the housing market. We can't afford these rates any longer. And that's really just because for the last 10, 14 years or so, rates have been far lower. And the last time they were anywhere near this, they went down very quickly. So keep those expectations in that 4.5–5% range. And I think you're going to end up being pretty close to where we'll finalize for the long term. So here's a common question that we've been talking about quite a bit. And a lot of folks are asking, Pat, have you seen CD rates lately? Why would I take risk in the market when over 6 months I can get 5%, for a year I can get somewhere just under that? seems like a no-brainer to go out and buy some CDs and lock in these interest rates. We haven't seen these rates in 10 years. Why wouldn't I go lock in with no risk? Well, I can understand where you're coming from. CD rates are very attractive. We have not seen rates in this neighborhood in quite some time. And for those of us who have grown up on the 4% rule for the retired crowd, hey, all you need is 4% out of your portfolio and you can live off of it forever. Well, that does factor in some growth as well. So if you're only getting 4% off your portfolio, eventually you can run out of money. But second to that, we have to understand our own behavioral aspects of finance. And if you go back to 1984 on the left there, the peak rate was somewhere around 10% for CDs. So if you're a consumer, you went ahead and locked in a 10% CD rate, you're feeling pretty good about that. Well, your neighbor who's got some money in the market actually got 3 times the rate of return for a diversified portfolio. So not a lot of us are going to still be happy with our CD rates 6 or 12 months from now when the market shows that historically, when these types of rates peak, it's a very good time to be invested in the market and to hold on to those investments. So I go back to the financial planning side, and not to step on Marshall's toes with this, but think about your investment plan. Don't let short-term interest rates dictate how you invest. If you have a need for CDs and for safety in part of your portfolio, absolutely great time to pick some of those up and have the right structure in place. But as a substitute for a diversified portfolio of growth assets, stocks and bonds, I wouldn't name CDs or short-term rates as the more attractive option. So I like to finish up here with a long-term chart. And I say long-term, it goes back 10 years in this case. It's funny to say 2014 is 10 years old. But we're looking at some of the major indices and a couple other asset classes that are often piled into investment options for the long term. So top of the chart there, you've got your NASDAQ total return, pretty robust returns. If you're able to ride that ride, you've done pretty well over 10 years. The S&P and Dow Jones, still very respectable returns. I don't think any of us are going to walk away from those anytime soon. Then we get down into more real assets, if you will, and these are becoming more and more popular conversations. Again, if I had another nickel for every gold advertisement I've seen in the last few months, we'd be in a different place. But we're representing gold here with just the price in U.S. dollars. So, there's a number of different activities involved there, but you're up, in the neighborhood of 70%. And then we're representing real estate on the passive side of real estate. So I hope my realtor friends don't jump on me for this one. There's a lot of different ways to invest in real estate, but this is just looking at the passive Vanguard real estate ETF. Still pretty respectable in the 70% range. Then we get down to the dark purple, which is the important point of this chart, and that's your CPI. So CPI of about 30% in that same time frame. This really illustrates how you want your money to grow over time and to maintain your purchasing power over long periods of time. So there are different ways you can invest in different asset classes, and there are places and portfolios for having diversification and not having different asset classes. But if I look back over a long period of time, it's hard pressed to say I don't want to own businesses. I don't want to own stocks or fundamentally strong companies. For outpacing inflation and maintaining my purchasing power, I still think well-run, solid companies here in the United States are going to be one of your best bets, as history has shown us over the long term. So want to make sure we open up plenty of time for questions, and I will pass it back over to Marshall here and see you folks at the end.
Thanks, Pat. Appreciate it very much. Good information. We'll even drop into it a little bit further as we move through the rest of the presentation this morning. But jumping in on the economic update side of the world, here's some interesting stuff for us. So in Q1, of course, we found that inflation is moderate, but it's stuck. They can't seem to break that 3 level. We'll look at the exact numbers in a minute, but it seems like the as Pat alluded to, we hit the 9, we got down to 5, we got to 4, we got to 3, and man, we just can't break 3 and get down to 2, where the Feds say that's okay. At 2, that's where we're going to start the rate cuts. We got political tensions. I mean, it's campaign season, but it's not campaign season. I think it's pretty much a given that we're going to end up, for the main part, with the Biden-Trump round 2. Nasty words go back and forth, and we know they're only going to get nastier in the coming months. Geopolitical tensions. The president signed a bill yesterday, or an act, I guess, that gave about $95 billion to what I'll call the 3 war zones. We'll talk about that in just a minute. We've got interest rates. They're relatively low, but as Pat alluded to, they're stuck. I'll give you some trading ranges we've watched in the last 3 months, but they're just kind of stuck, waiting on the Feds to move them in a different direction. Unemployment still historically low, but stable. We'll get on the specific numbers of that. And consumer demand, man, the consumers have jobs and demand is still high. So let's look at what didn't happen last quarter. Number one, U.S. did not default on its debt. We had some extensions and increases on the debt ceiling. The U.S. dollar didn't cease to be the world currency. I think you see those commercials almost as much as you do the gold commercials that Pat discussed. Corporate earnings didn't collapse. We're seeing many corporate earnings come in, beating expectations. We're seeing some not meet expectations, which is pretty much the norm. The U.S. economy did not fall into a recession, but as we found out this morning, GDP did decline a little bit. I'm going to talk about that. And so what really did happen? Let's take a look. Well, first off, Chair Powell says we are headed for a soft landing. And this is from a number of economists via the Wall Street Journal, which we consider to be a reasonable source for economic information. And now we have most economists thinking the Fed's going to pull it off, that the Fed's actually going to hit the soft landing. Of course, I'm the eternal optimist. And so let's give them the benefit of the doubt and hope they do. But we've got only about 40% of the economists saying that they think there could be a recession within the next 12 months. That's a good sign. It wasn't too long ago that we were up above 50% and up above 60% saying, oh my gosh, here comes a recession. Keep in mind, recession doesn't equal 2008, 2009. Recession is a normal part of the economy, but of course that was deemed the Great Recession. So we don't want to see one of those again, but a recession is a normal part of the economic cycle. So let's talk about the soft landing. Whatever you call it, growth has slowed. That became even more prevalent than the next slide I'm going to show you. But in this case, that's the goal of the Fed. We had a hot economy going. GDP was hot. And, demand was just crazy. Supply chains were messed up. And so the Fed's goal was, okay, we got to get all this back under control. The question is, what will growth or the lack thereof be for the remainder of 2024 and beyond? Well, last year, the economists and the Federal Reserve officials predicted that the U.S. economy would be sputtering by now. By sputtering, potential recession, as higher interest rates cut into spending as well as investments. The opposite was happening, and now we're seeing a little bit of a slowdown, but you would think it was almost the end of the world according to the market today. Chairman Powell says there will be growth overall for the full year, and in multiple statements, he's left the door open for future action based on the evolving data received in coming months. It always amazes me that I sit and I watch his press conferences and I hear him say simply those terms, we're monitoring the data. And the next thing you see are headlines, Feds are going to cut rates. Well, yeah, they're going to cut rates at some point. Yes, then some point in our lifetimes, hopefully they'll end up raising rates again. It's going to move, but he has not given that indication that he's ready to move off of the pause and wait and see. In other words, it looks like it's working. Let's give it a chance. a watchful eye approach. The next meeting dates are next week, as a matter of fact, April 30th and May 1st, and then again June 11th and 12th. I'll go on the hook and I will say, I don't think they're going to do anything next week. And maybe by watching the data, seeing the April numbers, seeing the May numbers come in, maybe we'll see something at the June 11th and 12th meetings. I'm not certain one way or another. So, what's the big hoopla this morning? One of the reasons we do our quarterly economic update on the fourth Thursday of the month is the release of the GDP number that comes out at 8:30 this morning. So this is hot numbers, folks, and Pat and I really believe that this is the way we want to present it, is with the latest information we have. So numbers came out at 1.6 for GDP for Q1 of 2024. Not what the market would have liked, but probably a little closer to what the Fed was looking for. So it's still a decline. It's not a recession. Consumers spent on the refilled supply chain of vehicles and online purchases and, of course, dining and entertainment, but at a slower rate. Government spending was down as well. So the question still remains, what happens now that savings are being exhausted, credit cards are getting near the max, higher interest rates for financing cars and appliances, and all that's making those items a little less affordable for the consumer. But consumers have jobs, consumers have income. And as we know, if the American consumer has a dollar, they will spend it. I'm not sure anyone anticipated the dramatic level that we saw with GDP going from 3.3 down to last year down to 1.6. But what is normally tepid news because of decline, I think is actually going to be good news with respect to the Fed. We're having to think a little bit backwards because we're all geared for a growing economy and robust GDP, but no inflation. And it's kind of hard to have all of that utopian activity at one time. So this may be the help that gets the Feds to start dropping rates again and, of course, get the economy a little better balanced, I think is the term that we're looking for. Inflation ticked back up in the first quarter. We're back up to 3.8 where we were down to 3.4. That tick has caused the Fed to stall just a little bit. Not to anyone's surprise, the market wasn't enamored with that information because they knew with the tick up inflation of inflation, that meant that the further delay in the decline of interest rates. A little humor for you. You read and you hear all the challenging news every now and then. You got to just take and have a laugh. Remember the debt ceiling crisis? Well, as long as Congress keeps kicking the can down the road, we'll continue to face these crises every few months. The real winners, of course, are the pork recipients whose votes are purchased, and the losers are the American taxpayers. That's just life as it is in the U.S. The U.S. debt. During our annual economic update, I mentioned you might want to follow David Walker. David's a friend of mine. He's the former Comptroller General, or basically the CFO of the U.S. He continues to post articles and do interviews about fiscal responsibility and the truth behind federal spending. Nobody knows it any better than David. I'm not sure which party would have the most impact or negativity as a result of the Kennedy campaign. But the biggest concern right now in the polls that are taken by the major news outlets is that we may have one of the most apathetic elections in history. It's almost I'm not voting for this candidate. I'm voting for this candidate because I can't vote for that candidate, and vice versa. And the concern is that the American voter won't show up at the polls, and we have no idea how that election will turn out. But just think, only 194 days of campaign ads left until Election Day. Be over before we know it. So many times clients ask, which party is better for the economy? The reality is, and I'm going to push this several times, it's policy not politics, that drive the economy. And I know you've heard, if you've turned into these presentations, that's a recurring mantra for us. More times than not, the House, the Senate, and the White House are not controlled by one party. So the balance of power results in stagnation. Very little gets accomplished. Well, what have we watched for the last couple of years? Stagnation. No significant legislation coming out. But as you can see from the chart, if my party is in power, I'm happy. When the other party is in power, I'm unhappy. I'm sure that's a huge revelation to the educated listeners and viewers we have today, but that's just how it works. You want your team to be in charge. There's one huge issue coming down the track, and that's going to be the sunsetting of so many tax provisions at the end of 2025. To take you back, when the Trump Tax Act passed, Congress decided they would sunset all of the key provisions, and I hate to say all, but the majority of the key provisions, especially estate taxes, in 2025. The logic behind that was that if Trump had been reelected in the 2020 election, he would have been out of office by 2025. You knew you would have a new president, new cabinet, and so they pushed so much, passed so much legislation, but pushed the expiration or sunsetting into 2025. So 2025 is going to be critical to those of us who pay income taxes or have an estate that we want to pass on to the next generation. So stay tuned. We won't know what's going on until after the election, and we'll see some kind of a guess or a leaning as to which way things may happen. Geopolitical tensions. Well, this hasn't gotten any nicer, but things haven't really changed in the last quarter. The concept of the truly global economy continues to be more evident than ever. That Europeans have had to cut back due to their dependency on Russian energy. Ukraine wheat has caused wheat cost and commodities prices to do nothing but increase. The war in Ukraine just seems to continue to drag on. As I mentioned, the president signed into law yesterday another round of aid for the Ukraine, and it's really just becoming a proxy war between Russia and the West and who will step up to fund it. We have the Hamas versus Israel, and of course that includes Palestine. We see all the Palestinian protesting going on. That has spilled over to impact the supply chains in Europe as well. As a result, ships are now having to navigate around Africa to get to Europe. And of course, that's created more supply chain disruptions in the Eurozone, where their economy was already having greater challenges than the U.S. and suffering because of the war in Ukraine, now the war in Israel, and it's really just a very challenging situation. China continues to support their neighbor Russia and threaten hostilities against Taiwan. Now that Iran has gotten into the fracas with Israel, I don't see this calming down in the short term, and wouldn't surprise me to see some escalation. So geopolitical tensions are well worth keeping a watchful eye. On the interest rate slide, the critical driver, and you saw Pat's inverted rate curve a few minutes, but the U.S. Treasury continues to vacillate somewhere between 4 and 4.5%. And that's been going on for most of the first quarter. The driver, of course, is the start of the anticipated Fed rate cuts. Whenever someone of reasonable standing posts, well, we think the Feds are going to cut rates this date, and draws a line in the sand. If that's sooner than it was, well, we'll see the Treasury drop a few basis points. Then someone else who's credible says, no, looks like they're going to have to extend it out. Well, boom, the 10-year Treasury bumps back up again. Near record home prices around the U.S. continue to make it difficult for first-time buyers to compete. Of course, we see interest rates are still triple or a little more than triple in some cases what they were just 3 short years ago. My realtor clients that were in during tax season keep saying the biggest hurdle is still supply, that they have so few houses to show the potential buyer. And you do have some of the new properties coming on, but not nearly at the rate they weren't were. But common sense. Existing homeowners aren't willing to give up a 2.5% mortgage to go get triple that interest rate or higher as a home mortgage interest rate. So it's going to be a while. I'll go on the hook right now and say I don't see that we'll see these rates in a major decline in the earlier part of 2024. Maybe we'll get some relief in the latter part. Demand for mortgages and refis have fallen off. The refi market just really doesn't exist. Rental demand is drying up a little bit. Higher prices came on in the rental market. That has begun to slow a little bit, just simply because demand is beginning to wane in the rental market because of pricing. Well, here's a bright spot to us on the average side, but not a bright spot necessarily for the Feds. Unemployment still hovers at 3.8. That's 1/10 of a point from where it was in December. To me, that's a rounding error. That's not a big deal. So unemployment is still remaining strong. As a result of that, it's staying below the 4% that is the Fed target. However, consumer confidence has begun to wane just a little bit. U.S. consumers are feeling so-so about the economy despite inflation's negative impact on purchasing power and sentiment. Consumer spending growth has been remarkably resilient even though the confidence is down. We're back to what I've referred to in prior quarterly updates as the YOLO, or you only live once generation. Well, why is this happening? Consumers have jobs and they have money. And so the latest round of bank earnings shows that apprehension still hasn't kept Americans from reaching from their credit cards. So they're spending their last cash reserves on traveling and enjoying their one life. So we'll keep watching. Will their confidence begin to perk back up? It's going to take something in the market, like an interest rate cut, to get it. The slight decline in GDP is not one that's going to stimulate consumer confidence. Leading economic indicators. Well, there's a slight decline, but not a major decline. If you look back at the decline from 2022 to 2023, and then now from 2023 at 103.1 down to 102.4. Not a dramatic decline in the leading economic indicators, but no less a decline. Keep in mind, this is the goal of the Fed, not the goal we would look for in normal economic conditions. Now, the LEI has given us no signs that a recession is around the corner, but neither is substantial growth. So again, this might be tepid news, but this is the goal of the Fed. So if I can leave you with one thing today, it's that the Fed game plan appears to be working. We're not seeing dramatic shifts. We're seeing slight shifts. And that obviously slight means soft. And so the soft landing to the economy, which is the target and has been stated as the target from day one. So what do you do about investing in uncertain times? Well, keep in mind, these are not recommendations to buy or sell. They are presented for information purposes only. But let's look at market fluctuations. Here's the S&P. Nothing looks out of the ordinary. The market recovery trend continues. Keep in mind, corrections are declines of 10% or more, but less than 20. Those are the blue shades that you see on the chart. Those are the pink shades. The minor, the 5 to 10% are in the blue shades. You see the bear markets that are actually in the pink. My apologies, that's the 20% or more declines. We saw that major hit that hit at the end of 2022. But 2023 was a good year. 2024, at the middle of 2023, we had a correction, but yet 2023 turned out to be a good year. Nice fourth quarter rally. 2024 has shown good growth. We've seen a little pullback here in April, and of course the market is really having a challenging day today. All the indices are down about 2% as a result of the GDP numbers that came out just earlier this morning. So keep monitoring. So obviously, that always begs the question, when should I invest in the market? Should I try and pick a bottom? Should I stay away from the top? What should I do if I'm an investor? Should we wait until the market cools to invest any excess cash? And Pat did a wonderful job of addressing the fact that, cash sitting on the sidelines making 5% when you're withdrawing 5%. And on that 5%, you got to pay taxes and you've got all sorts of income, coming in, but not covering everything you need. That's a challenge. So we'll see what happens. But here's the reality historically. It doesn't matter. If you're an investor who's staying in the market for the long haul. Yes, when you look at the chart, 3 months, we all know that 3 months can be anything in the marketplace. 6 months, it's close. But after you get to a year, you find it really didn't matter. So the key word is to invest, not speculate. In the short term, anything can happen. Of course, Chairman Powell might sneeze, but in the long term, being an investor, the chart speaks for itself. Note, returns have historically been slightly better when investing at new highs. Well, that's that momentum that can usually get you a good roll over a period of time. So what should you be doing if you're the smart investor? Well, here we go, our usual stuff. Financial independence and security for our families when we are living and when we are not is the goal. So sound economics and financial planning should never go out of style. Stick to the basics. Find quality companies, stay with them, ride them for the long term, and continue to monitor your portfolio. But don't do knee-jerk reactions of what's going on in the marketplace. It's way more important for you to be focused on your long-term plan to meet your long-term needs. So we had one question that we had gotten earlier, and that's, I'm going to put you on the spot. Okay, we're not seeing the interest rate change that we anticipated. If you take a look at your crystal ball and see if you've got any idea when you think the market at least is thinking when Feds are going to begin a rate cut. Will you go on the hook for that, or going to drop back 15 and punt?
I would love to punt, but I know I tend to do that a little too often. But certainly we started the year with expectations of a few rate cuts, and that changed very quickly. So as of late, the market had priced in, if you will, if you look at the Treasury market and the futures markets, priced in rate cuts not until September or November. I think with some of the information coming out today, the GDP numbers that you highlighted, we'll have to revisit that and see how the market starts to reprice maybe earlier rate cuts than they thought. I think you're going to need to see a little more consistent downtrend in GDP, and the Fed will more seriously entertain rates. But when I look out on the yield curve, which we mentioned in the 5 and 10 year time frames, you're still seeing sub 5 interest rates, meaning that people or lenders are willing to lend their money for 5 or 10 years at about 4.7%. That was before the market opened this morning. So I look at that as still the bogey, if you will, that we've got to get back down to that range. And I think we're with a little bit more coming out as far as GDP and some of the numbers softening a little bit, we're probably closer to that now than we were a week or two ago. So end of the year, if we cut once or twice by the end of the year, I don't think anyone's going to be surprised by that. Further than that, I think you need to see some pretty big moves in the economy to the negative side to see more rate cuts than that.
Couldn't agree with you more, and thank you. Keep in mind, over the long term, again, it's policy, not politics, that drive the economy, and the economy drives the market. It is as much about who lives in the White House or How are the House, Senate, and White House controlled? If there's a balance of power, not much is getting accomplished on the policy side. But there will be lots of politics to scare the market between now and 194 days in the election. Hopefully, it's over in 194 days, doesn't drag on. But all that is going to just come back and tell us the same things that we've known forever. And that's to build your investment portfolio with companies whose profits are not tied to politics. So, regardless of who's in the White House, people will continue using Charmin, eating their food, taking their drugs, and using their cell phone. We all know this is how America works. And thank goodness it causes a lot of stability for us. Our next scheduled event will be our second quarter economic update on Thursday, July 25th at 10 a.m. Same time, same channel. We'll get you the information on that. Be watching your email to register. I'm certain it will be interesting, and I can't thank you enough for joining us. We look forward to meeting with you soon. Take care. Have a great day.